Welcome to Inscriptions 18. Gurus Speak. Chapter Wealth that Grows and Lasts Forever. Principle number 6. Financial Pyramid. Risk-free growth. The pillars. So far, under Principle 6, we have been discussing financial pyramid structure. And we started off saying that protection is the foundation of the building. If we take an analogy of construction of a house, we start with foundation, and the foundation to this pyramid is protection. Protection is the area where we try to protect our earning capacity. The risk on which this earning capacity can be affected need to be protected against. For example, life insurance, critical illness insurance, disability insurance are the products which will appear at this stage. Having constructed the foundation, the next job will be constructing the pillars for the house, and that is the risk-free growth area. This issue we will be focusing on the risk-free growth area. As the name indicates, these are financial instruments where there is no risk on the capital, or the least possible risk, almost zero like risk. People work hard, they earn money, and they save money from out of these hard earned money. The purpose of these savings is that they should be available for a need in future. So much money has to be available for that designated event of future. What are the products which appear at this stage of the pyramid? Risk-free growth financial products, government-backed bank deposits, post office savings, public provident fund, treasury bills and bonds. Mind you, not company bills and bonds, they are all treasury bills and bonds. Not even the promissory notes of the companies, even though they are many times considered as a risk-free growth area. But that's wrong. We can consider only treasury bills and bonds. We can also consider endowment type of life insurance policies which offer savings benefits along with the life insurance cover. Now, why would anybody acquire such products? Because by and large it is discussed in the financial service area that these risk-free growth financial products will offer very less returns. Now then, why would anybody save the money in these products? There are three basic purposes for which a person must have risk-free growth properly and adequately done before he can venture into the third stage of the pyramid called as growth with risk. Now let's look at the reasons one by one. The first reason is the safety of the money saved for future. As I told you, people work hard, they earn money, and a part of that money they save. So one of the concerns related to this money is the safety of the money. We have earlier discussed that in the cash to cash cycle picture, men work hard, they make money, from out of the money they buy assets, and later they convert these assets into cash or money to be used for their needs. Therefore, cash is the king and assets are intermediary. Therefore, to take a decision on what assets could be good for us, we need a map of life. Suppose we draw a map of life. The map of life will appear like this. The initial part of our life is supported road. Could be 20 years, 25 years, or even less than that. This is the part of life where we were supported by others. The moment we start earning money, we may not need support from others financially. That is the time we get into the road, independent road. The moment we get into responsibilities of life, like marriage, children coming into the life, so that is the time we enter the supportive road. In the supportive road, we have to understand what are the important junctions for us. So therefore before even selecting the assets where we should be saving our money or investing our money in, we must therefore decide during the supportive road or thereafter when we will be requiring money, how much money will be requiring then, and for what purposes. If you look at the movement of a rail, the rail stops in bigger junctions for a longer time and smaller stations for very few minutes. If I take an analogy of the same, the normal requirements, the month-to-month requirements, the ongoing expenses, etc. Suppose we take their stations, which will be governed out of the income, which will be covered out of the income of a person. For the bigger stations, which require bigger money, savings is required. Now we can therefore mark junctions based on the priority. Look at this. These are all priorities, junctions, time when we will require money. The blue color ones are not negotiable junctions, which are emotionally very important for us, which are probably a bigger part of our basic responsibilities or towards these junctions. Whereas if you look at the pink colors, nice to have junctions, yeah, they're all junctions where it's really nice to have them around, but they should not be funded at the cost of not negotiable junctions. The priority should be first we provide for the not negotiable junctions. Now then what do? Each of these junctions require money. Now suppose we classify the money required into three categories: the minimum amount required, the reasonable amount required, and an aspirational level of that junction, the amount required for the same. Strongly advise the minimum amount required for these not negotiable junctions should be funded through a risk-free growth products. We just cannot afford to take risk on the capital towards these goals. Mind you, they are not negotiable junctions. For example, children higher education, the world-class education of children, child marriage, helping them to settle down in life by investing into their businesses to start with, maybe a very independent and contributing life. And the minimum amount required for these goals, at the minimum level, let's say, has to come through the risk-free growth area. Why? Now, if you look at risky investments, let's even say, for example, a stock market investments or equity-based funds, there are indicators on these funds as to how much risk they are in comparison with the primary index of those respective countries. For example, an indication of beta. Beta 1 represents, if you take India, Sensex or the Nifty movement, how volatile they can be. Now that you have seen the supportive road and the junctions, not negotiable junctions, minimum amount required. Now look at this beta. If you look at the last 20 years, how the variation, the volatility, the movement of this index is represented by beta 1, that is a blue color graph. Now if you study your investment brochure and if it is mentioned as beta 1.22, then you may end up with this type of a graph. If it's 1.48, which is 48% more volatile than the primary index. You look at this graph and look at the peaks and the valleys. Now, not negotiable goal junction at a minimum level cannot be open to this risk. Therefore, such not negotiable goals at the minimum level has to be funded through risk-free growth products. The second reason why a person should have the risk-free growth in his portfolio to make a proper construction of the financial pyramid is the holding capacity during turbulent times. Now these products offer holding capacity. If you look at a journey a person is doing in his by a, let's say a train, and he got a good seat there, the person need not hold on to anything. The movement is smooth, even. But if the person is traveling on a roller coaster, a ride on a roller coaster, then he must hold on to something very strong. Turbulent. During even movement, we don't need something to hold on to. But during turbulent times, to ensure that we don't fall off, we need holding capacity. These risk-free growth products offer that holding capacity during turbulent times. Let's revisit the beta 1, beta 1.22 and the beta 1.48 chart we had seen. Look at the volatility. Turbulent, goes ups and downs. It's not an even growth. Even though if you look at a CAGR graph normally shown in the brochures, it's a straight 45-degree line. But in reality it doesn't happen that. We undergo this amount of turbulence to reach the destination. 1.22, 1.48. When people do not have holding capacity and there is a need in that year, they will have to get out in negatives. Look at this. Look at this. 2008, 11. But suppose they hold on for another couple of years, or even a year, or maybe 3 years, then they will be able to make the growth they had looked for in investing in this product. For example, look at this. Now, if they can hold on to this period, I'll show again. If a person can hold on to this period, at this period, look at this, then yes, he can make money. Assuming that this person has no risk-free growth area products, is directly gone into growth with risk or taking the risk, then how can he hold on? If he holds on for 2 years, then he'll get it. Or 3 years, or 1 year, we don't know. Therefore, adequate holding capacity is required. Repeat again, look at this. Now look at this again. All these growths are possible only when people can hold on. And how? And what gives them the holding capacity? The risk-free growth area. They have money, so they say, okay, let me allow this, and I can take it next year, but I'll use this money for fulfilling my goal at a minimum level. The third reason why risk-free growth products will be required is they can be encashed at a short notice. We don't know when emergencies come calling on us, in which case we need money. These products offer encashment at a short notice. There are two aspects about these products which make it encashable at short notice. One, the buyer is ready. You don't have to search for the buyer. Assuming that you have a post office account, you give it back to the post office and take your money. The buyer is ready. Suppose I had, let's say, jewels or car or any other type of assets, let's say, for example. I have to search for the buyer, even a land for that matter. Here I don't have to. The buyer is ready. But not only that, but the second important factor is that it is encashed at a pre-decided price. See, when we are able to surrender or let's say withdraw from our mutual fund units, the buyer is definitely ready. The mutual fund is ready to take it back, but not at a pre-decided price. The price is dependent on that day's anyways. Or if you look at other assets, many times the price is decided on the seller, what sort of a compulsion he or she is, how urgent he needs the money. People get into negotiations, and the more the crisis he is in, let's say, the worse the price he gets for his asset. Therefore, because of these two things, buyers ready and pre-decided prices, the risk-free growth area provides encashment at short notice. The risk-free growth area, which is the second part of the financial pyramid, is akin to pillar, a foundation in terms of protection, and we now have a risk-free growth area in terms of the pillar. If we have not provided adequately for protection based on what we have discussed last time, capital need analysis, human life value and net worth, our first responsibility, priority would be to fulfill these needs. Having done it, our next important area would be risk-free growth. Many times, people are persuaded not to invest in this area, risk-free growth area, only on a single factor, that the returns are low here and they may not be adequate to beat the inflation. But my dear, we can't construct straight ceiling from the foundation. There has to be something connecting the foundation and the ceiling. Pillars and risk-free growth area offer the pillars. We'll be discussing more about this risk-free growth and how much money will be required under the risk-free growth. But only to summarize very quickly, we've understood that products like government-backed bank deposits, post office savings, public provident fund, treasury bills and bonds, endowment types of policies of life insurance which offer savings benefit along with the life insurance cover. Why would anybody invest here? Safety of the money saved for future. How much it should be? It should be even to the extent of, at least to the extent of, not negotiable goals at a minimum level. Nice to have goals can be funded by choice, but the minimum amount required for not negotiable goals have to come through the risk-free growth area. The second reason why we need to invest there is holding capacity during turbulent times. If we are able to hold on, we can overcome the turbulence and may be benefited because of the turbulent growth which happens thereafter. The third reason why we need to invest here is can be encashed at short notice. We'll discuss this chapter again later in Inscriptions 19. Thank you so much. God be with you all. Let us not ignore this part of the pyramid just for the reason that the returns are low. You must also understand the risk is absolutely eliminated here. We at least get back the money which we saved from our hard-earned earnings. Keep reading inscriptions. Bye bye.